Who's going first?
Hello and welcome to today's news video. Today's video is going to be on the back of inflation figures published in the US. I think it's up 4.2%. So we're just going to have a general chat about why that might have occurred and the implications of that going forward.
Yeah.
We don't claim to be experts. We maybe be experts one day in the future, but at the moment we're just liking learning about it and putting our perspective across.
Yeah.
So Joe, you get going with it. Let's talk.
Yeah. So, well, first of all, the 4.2% increase was an increase from the downturn in March/April of last year. So, before everyone starts panicking, it's because it was so low last year. You know that increase is always going to be big.
So that figure is likely to be large for the next few months, probably into September, October, isn't it? Until things start easing at the back end of last year, because each one of those monthly figures are being compared to inflation figures last year, which were obviously an all-time low, or very low, given the pandemic starting at that point.
Exactly. So there's quite a few reasons why inflation's ticked up. I think common sense is that we're all coming down. We're all coming up from them lows. So we've not been doing anything. Everyone's been locked away. Yeah. And all of a sudden, there's been a lot more demand coming through, going out, being able to, buy clothes.
They're obviously anticipating that surge in demand for the things that have been sort of taken away from us in the lockdown, things like hotels, restaurants, flying, clothes, that kind of thing. They're all expected to see a surge in demand in the coming months, aren't they?
And hopefully, if you think about the simplistic supply and demand graph, when demand increases, what you'll get is an increase in supply if supply cannot keep up with that demand, and which has happened because there's been supply chain issues and commodity price increases. So it's more difficult to get commodities. There's been issues with like lumber mills in the US. So again, if you look at lumber prices, that was a massive increase in the US. And that's feeding then through the housing market in the US, because a lot of the houses in the US use lumber. So all of that sort of stuff is feeding into that overall jump in that number there.
Yeah. And also there was those figures by the Labour Department in the US again that was showing job openings in the US were at a record high in March of this year. So that again, if there's a shortage of labour, that means that companies generally will have to pay higher wages to get someone in and get them working. And then they translate that, don't they, into higher prices usually. Because there's that buffer in the market. They're thinking, well, if people are asking for higher wages, the economy must be doing well. Therefore, we can translate that into slightly higher prices of our products.
Yeah, and I think with a labour shortage, possibly stimulus checks and unemployment benefits that probably reduced market participation in terms of labour. So if you might not want to enter the labour market and work because you've had the government supporting you.
Yeah.
You've also had these stimulus checks. So not only that's increased demands because you can spend that money on things. You've also got that fact that you're getting essentially free money from the government. So you might not want to work or go back to work as soon as you can do. So I think that could be a factor as well, playing into the inflation, because there's less labour and there's still that demand though, because you're being paid by the government.
So on the back of the stimulus checks, then obviously we know 1.9 trillion was the overall figure. So that sort of generally translates to there's too much money in the economy, isn't there? And it's trying to be spent on too few goods, basically, and that has the general effect of driving up the prices. And I read a stat actually that $1 in $5 in circulation in the US currently were printed within the last year.
I mean,
yeah, that shows the rate at which the central bank's been printing this money and trying to create this stimulus in the economy.
Yeah, that's quite amazing, actually. I didn't know that. So yeah, we've sort of gone over a few things there straight away, which shows you that prices are increasing because of the supply side. They're struggling to supply the goods, and the prices generally are much higher. So I think we've got a figure for gasoline prices alone, we're up 6.4% in Feb. So again, last year, really low, because why? You weren't driving to the shops, you weren't going on holiday. Now you're doing a bit more driving.
So again, that figure looks inflated because it is compared against a very low figure last year. I think people would start to be concerned if that figure continues at that kind of 6% rate. If this time next year it's at that rate, then people might start being concerned, because things have started to pick up at this point. If it continues rising in the same exponential rate, then we might really be having, going towards the sort of over 5% inflation. But that is what they're sort of saying is dragging it up, isn't it, at the moment, is the commodities, things like copper and
industrials.
Gasoline, crude oil, that kind of thing, because those industries are getting up and moving again.
So far, the Fed thinks the rise in inflation is actually transitory.
Due to transitory factors.
Yes. So they have come out as a position of not being overly bothered about the inflation rate increasing.
Which they were probably always going to do to begin with, because they're trying to keep anxiety and fears low, keep that uncertainty level.
I think it's also, inflation we haven't touched on yet. It's also, expectations. Expectations do also play a big part in inflation, because if you believe that prices of goods will rise, then you, instead of saying you'll buy a computer in 2 months' time, you might want to buy that computer in a week's time, because the Fed said, right, inflation's going to be here. All of these goods will go up in price. And then obviously that creates further demand for them goods, which means that more dollars are chasing, fewer goods.
And which
and
drives
faster.
it further.
So it can create that sort of snowball effect. And also, I think probably the Fed is thinking that we've gone into this period of time where inflation has been incredibly low. And the Fed is trying to do everything in its power to create inflation, because they've struggled to have any inflation whatsoever.
The Fed needs some inflation, because really at some point they need to put their interest rates back up, because if interest rates stay so low and then something happens again, be it a repeat of some sort of pandemic or whatever happens, a bubble bursts, and they don't have the option or the tool of cutting interest rates and trying to make people spend in the economy, making people less inclined to save their money. They don't have that tool, then they're going to struggle, because what else do they turn to? So exactly. Like they need to create inflation, don't they, at some point?
Yeah, 100% agree. So that's just an interesting point, that they think it won't probably last sort of too long, and that will be, we'll see if that happens or not, to be honest. But
So we'll finally, I think, just touch on the effect that's had on the stock markets. So just the other day, the FTSE 100 closed at 2.47% lower, didn't it, than the previous day? Or was it Yeah, the previous day. So it fell below the 7,000 mark, didn't it, for the first time in a while?
Yeah. So yeah, I mean, stock markets have been at all-time highs. So you know, a drop.
Mainly probably because where else do you put your money at this point?
Exactly.
With
So
interest rates so low,
yeah,
you've got to look for assets like stocks and bonds that tend to, well, that definitely should be outperforming a 0.0% ISA or something that you've got.
100%. So yeah,
Look,
Andrew brings up a really good point there. Really good point, and that's been true because you know, some of the numbers with people's savings been huge, stimulus checks, and everything we've talked about already has fed into the, you know, market. Retail investors have gone through the roof. Everyone's been bored at home, and you've seen that in, going off on a tangent now, but seen that in stocks like GameStop, you know, up hundreds of percent, and it's a crappy company that has no future, but
no value.
No, so yeah, you've seen that in the market. So the drop in the stock market is probably not as a big a deal as the market itself is making out of.
No.
You essentially, you've got companies that have had a massive run up because of the pandemic. So a lot of tech companies that have what is called a high PE ratio. So a PE ratio is just
price to earnings ratio, isn't it?
Yeah, exactly. So, and generally, they're companies that are going to be forecasted to have high earnings growth.
So when you say price to earnings, that means their current price. A high PE ratio means their current price is high.
Yes.
Compared to their current earnings.
Current earnings, yes, exactly.
Which obviously means then high PE ratio means that they're likely got high future earnings expectations. Is that right?
Yeah, so it means that essentially money is going into them stocks because of expectations of future earnings.
Yeah.
And analysts calculate these future earnings, and a lot of stuff goes into these calculations, including stuff like inflation expectations and interest rates, more significantly, really, interest rates. But again, interest rates are, you know, correlated to inflation in you know, because
one goes up, the other goes down, generally.
So yeah, generally. So interest rates have been at all-time low. So the analysts have, you know, calculated high earnings growth, but these numbers can change with the change in interest rates and inflation. So these companies have seen a sharp fall because
that's
of the
mainly because of with inflation showing over 2%, and the expectation is that it may continue.
Yeah.
Then the expectation is that those higher prices will eat into the profits of those. Generally, tech companies seem to take the hit, didn't they, recently?
Yeah.
Those companies with the high PE ratios.
Yeah, yeah. So, and then there's also been, because of, again, the stuff that we've talked about in this video, the commodity price increases. So you've had a shift towards companies that have got exposure to the commodities. So, i.e., they can make more money off the commodity price increases. So you've got, that's been a general shift in the market. So that's why you've seen a little bit of sort of changes in the stock market, and why generally, you know, the stock market, you know, reels a little bit. And you can see this at the end of the day, when back in 2000, you know, late 2008, interest rates were kept on going down until basically all-time lows. Yeah. And then that all-time lows have stayed there for, you know,
a decade.
Yeah, a decade, which is quite scary when you think of it.
Yeah.
It's that long ago now.
Well, I mean, we won't go into it in this video, but that kind of goes against the teachings of the Phillips curve, doesn't it? which is what a lot of mainstream economists, and what you'll probably learn if you're doing an economics A-level, GCSE, or university. But we won't go into that. But what we've found anyway from reading a little bit more on the topic is, at the moment, most of the mainstream economists doubt that we're about to enter a sustained period of high inflation, but that is yet to be seen, isn't it? We'll see what the things are like in the next few months.
The thing is, we've got a backdrop of, like we said, very low inflation, and there's reasons for that, which we probably won't go into this video. We will have an inflation video on our channel
coming out soon.
Soon. So, or it will be there now if you watch this at a later date. So that also explains a little bit of the backdrop of why inflation generally for the past 10 years or so has pretty much converged across the world to fairly low rates.
Sort of 2% target, isn't it?
Yeah, well, yeah, below that 2% target sort of thing. So, yeah, I think it'll be more of a short-term issue because of the supply chains. But once people slowly return back to normal, you'll probably see that again, like we say, stabilise.
Yeah.
And maybe a few rate hikes by the Fed might also just taper back the excitement. So, yeah.
So we hope you've enjoyed that video. If you do have any questions, we'd love to hear them in the comment section. And we'll hopefully be putting out another news video probably next week, whenever we see a topic worth covering that we find interesting and engaging, and hopefully you guys do too. And we hope to see you in that next one.
Yeah, thanks for watching.
Thanks for watching.